Interest rates are very low. It's a fact. It's something we can't change. We have for a long time looked for different sources of returns, not just the beta of the equity market, the beta of the credit market, but different sources of return with their risks. And some of these sources are being paid for illiquidity or receiving an outperformance, so alpha. But it's just that in the very low interest rate environment, the pressure to earn the incremental basis point, 5 basis points, 10 basis points on the portfolio is all the higher. And that's why in recent years it has received a lot of attention and emphasis. It has changed, I would say, in the sense that investors, institutional investors looking at alternatives, have tried to find alternative investments that also have a yield. If you think about a hedge fund, that doesn't have a yield, it creates a trading profit. But if you think about alternative debt instruments, private lending, collateralized loan obligations, core real estate, then these types of alternatives have received a lot more attention, I think, recently, because they have a yield, because they pay a current coupon. This is part of our responsible investment strategy. You know, we want to do good, but do well at the same time. And the green bonds was just a concept we looked at early, and it was actually an easy decision to take. The analysis that you're not giving a concession on the return, you paid the right return for the risk, that analysis is really simple for green bonds. And also the tracking of the impact. So the green bond finances a project for sustainable energy creation or sustainable energy transmission. The fact that that happens is very easy to track by design of the green bonds. So among the many, many alternatives that exist to be a responsible investor and to create impact investments, this seem to be simple and relatively sizable in terms of the market potential, and thus very natural for us to adopt.